Okay, let's dive straight into this. Welcome to today's Explainer, everyone. Today, we are looking at a truly fascinating financial puzzle, StoneX Group, trading under the ticker symbol SNX. You know, if you follow the markets, you already know that finding a company with an incredible growth story combined with, well, seemingly contradictory fundamental metrics is literally like finding a needle in a haystack. But StoneX? It's exactly that kind of needle. We're going to put this financial juggernaut right under the microscope and look directly at what the data is telling us about their performance, their valuation, and their risks.
3,275.99%. Yeah, let that sink in for a second. That staggering figure right there represents StoneX Group's 20-year trailing return. I mean, just think about the sheer compounding power you need to achieve that over 2 whole decades. And even if we zoom in and look at shorter time frames, their 5-year return sits at an eye-watering 463.37%. Heck, they've returned nearly 80% just in the trailing 12 months alone. It naturally sparks a massive amount of curiosity, right? How exactly did they pull this off? And more importantly, what is driving this engine today?
To unpack this whole thing, we're going to follow a clear roadmap. First, we'll look at the explosive growth story. Second, billions made, pennies kept. Third, is the stock undervalued? And finally, weighing the liquidity risks.
All right, part 1, the explosive growth story. We are dealing with a true momentum machine here.
And I mean a massive momentum machine. Just take a moment to digest this absolute monster of a figure. $143.47 billion in trailing 12-month revenue. Right, billion with a B. We aren't talking about some hot, high-growth startup just finding its footing. We are talking about a globally entrenched entity moving hundreds of billions of dollars. To put that into perspective, that is roughly the GDP of a small country flowing through their systems every single year.
And these numbers brilliantly illustrate how this growth isn't just a sudden fluke or some random one-off spike. Look at the consistent double-digit compounding over the 3- and 5-year horizons. Their 5-year revenue compound annual growth rate, or CAGR, sits at a really robust 22.42%. But then, look at the earnings per share. The 5-year EPS CAGR is an astounding 53.97%. So they aren't just growing their top line. Historically, they've been compounding their earnings at an exceptionally high sustained velocity.
Moving on to part 2, billions made, pennies kept. This is where we run into the profitability paradox. Now, what's really interesting here is that this is exactly where our narrative takes a major plot twist. You naturally expect a massive river of profit from $143 billion, right? But consider this stark contrast. You've got a mountain of revenue on one hand and a razor-thin net profit margin of exactly 0.23% on the other. 0.23. That's less than 1/4%. You could arguably find better margins running a neighborhood lemonade stand. They are effectively skimming tiny fractions of a penny off of billions of transactions. It is a volume game in its absolute purest form.
Drilling down into the raw margin numbers, we see that it's not just the net margin that's incredibly tight. Their current gross profit margin is only 2.02%. And what you really need to take away from this is the historical trend. That 2.02% gross margin is actually down 26.69% compared to its 5-year average. So while the revenues are compounding massively, the actual margins they're extracting from those revenues are both microscopic and actively compressing relative to their historical baseline.
Which brings us to part 3. Is the stock undervalued? How exactly do we price this juggernaut? So, how is the market supposed to value a company with $143 billion in sales but a 0.23% margin? To figure that out, we need to quickly define a core concept: margin of safety. Think of this as your investor's buffer. It's simply the difference between what a company is intrinsically worth, based on cash flow, and the price it currently trades at. Basically, the larger the gap, the better the deal.
Well, the gap here is absolutely massive. Based on discounted cash flow metrics, StoneX has a current trading price of around $106.03, but a calculated fair value price of $258.84. That translates to an incredible 59.04% margin of safety. According to the specific fair value metric, the market is pricing the stock at less than half of its intrinsic worth. For any value investors watching us right now, this is the kind of metric that immediately sets off alarm bells, in a good way.
Let's see how this builds across other traditional valuation multiples. The trailing PE ratio sits at a somewhat standard 23.72, but look at the forward PE. It drops dramatically to just 9.79.
Furthermore, they've got a price-to-earnings growth, or PEG ratio, of just 0.30, which strongly suggests the stock might be fundamentally cheap relative to its rapid earnings growth. And because of that huge revenue figure we discussed earlier, their price-to-sales ratio is a microscopic 0.06.
All right, part 4, weighing the liquidity risks. Because looking under the hood means we also have to look for rust. So, the crucial point is, while the valuation looks remarkably cheap, looking under the hood of a financial juggernaut also means checking for vulnerabilities. When we rapid-fire the liquidity metrics, a much more cautious picture emerges. Their debt-to-equity ratio stands at a highly leveraged 7.87. Furthermore, their current and quick ratios both sit at 0.47. In plain terms, anytime a ratio is below 1.0, it indicates a company has more liabilities due in the next year than has short-term assets to cover them, and that points directly to potential short-term liquidity tightness.
But the concern isn't just the absolute number, it's the momentum of the risk. If we look at the trend, that 7.87 debt-to-equity ratio isn't a static figure. Their 3-year average was 6.22. Today's current debt load actually represents a 22.72% increase compared to their 5-year average. So the company is not only carrying a high degree of leverage to fuel that massive revenue engine, but that leverage has been actively trending upward over time.
Which brings us to the ultimate question you have to ask yourself based on this data. With compounding massive revenues and a deeply discounted fair value price, but operating on razor-thin compressing margins and an upwardly trending, highly leveraged debt profile, is SNEX a deeply undervalued hidden giant, or is it a tightly wound liquidity trap? The numbers paint a brilliantly complex picture. I highly encourage you to pull up the source data yourself, look at these exact metrics, and investigate further. Thanks for joining me on this explainer, and keep learning.